All right, today we are going live to talk about VA refinances. And I usually go live to talk about the VA one-time close, buy land, and build custom construction loan programs. And today we're going to just talk about VA refinances because a lot of people are interested in doing the one-time close, buy land and build custom construction loan. But a lot of people are looking at refinancing right now. We're hearing from a lot of our past clients. We want to understand what are our refinance options. And so we're going to talk about VA refinances. We're going to talk about cash out refinances, the interest rate reduction refinance, which is specific to VA buyers. We're going to talk about the cash out refinance if you're trying to actually cash out and pay off debt or remodel your home. If you want to add square footage to your property, if you want to do a VA renovation loan where you actually can remodel your home based off of future appraised value. So let's say you bought your house recently and you don't have equity in your home. The VA renovation loan will allow you to go off of what's called future appraised value. So we're going to go through that a little bit so you can hear what does a VA renovation loan look like. We're also going to talk about what it would look like if you had a VA loan and you wanted to refinance into a conventional loan to release your VA loan entitlement so that you can go purchase using your VA loan again without it being connected to that house that you used your VA loan on originally to purchase. So we're going to talk about that. What does that look like and how does that free your entitlement up for you to be able to use your VA loan entitlement, 100% of your entitlement with no county loan limit. So we're going to talk about refis, okay? I know this isn't as exciting as the buy land and build, but I also want to teach you how to refinance and leverage the equity that you have in your property already to invest that in investment properties, whether it be a multifamily or short-term rentals like a vacation rental. I'm going to tell you my story about vacation rental, how we bought our first vacation rental, how much we buy it for, how did we find it, what did we end up cash flowing on that, and then how much did we sell it for because we sold it as a business, which sold for way more than the house itself would have sold for just by itself. So let's start with cash out refinances because right now we're seeing this is probably the most interesting thing that a lot of people are looking into. We get a lot of questions. Does it make more sense for me to do a cash out refinance or a home equity line of credit? That's a very valid question because for those people that are owning homes, a lot of people bought those homes when interest rates were quite a bit lower. So if you bought a home over, I would say 18 months, 24 months ago, you probably have a very low interest rate. Or if you refinanced your home, during 2019, 2020, 2021, you probably have super freaking low interest rate. And obviously, if you've looked into where interest rates are today, they're not as low as they were for a long period of time. We were seeing rates in the 3s and the 2s. I have people that got a 1.99% interest rate, which is freaking insane. They say that you cannot service a mortgage for less than 2%. So to get a 1.99 interest rate is like having a negative interest rate almost, which it's not really, but you get what I'm saying. So a cash out refinance, what does that look like? What can you use the money for? So VA is actually the only loan program that allows you to do a cash out refi. When you do a cash out refi as a VA with a VA loan, you can go up to 100% of the value of the home. Now, I'm not saying that this is a good idea. And for those of you that have questions, post your questions in the comments. I'm going to have a moderator in there moderating, and then I will also answer your questions as I see them come up. But yes, on a VA loan, if you're not living in Texas, Texas is the one exception to this rule. Texas does have a rule that you are not allowed to take cash out on a VA or an FHA, government loan. You're not allowed to refinance and take cash out of the property. So you would have to do a home equity loan or a conventional refinance to take cash out of your property if you own a home in Texas. Otherwise, the rest of the country, all the other U.S. states, you're allowed to do a cash out refinance on a VA loan, and you can go up to 100% of your value. Now, if you go over 90% of your value, then you're going to pay a higher interest rate. So if you go over 90% of your value, and for easy numbers, what I mean by loan to value is if you owe $75,000 on your home, and your home appraises for $100,000, you're at 75% loan to value, okay? So if you are at $90,000 on what you owe and what you're gonna take out for a new loan amount, and your property's worth $100,000, you're at 90% loan to value. So when I say you can go to 100% loan to value, that means you can actually borrow 100% of what your appraised value is on a VA loan. So some people do this, and why would you do this? Well, we've got people that want to remodel their houses. A lot of people are staying in their homes right now because they don't want to buy a new, more expensive home at a higher interest rate, so they've decided to stay in their homes. And when you're living in your home, obviously, if there's anything that you want to do to your home, most people don't have a bunch of cash sitting around and want to dump a bunch of cash into remodeling a kitchen, or unless you're DIYing it and it's very affordable. But if you want to do like a full kitchen remodel or full bathroom remodels, or you want to add square footage to the home, or you want to build a shop outside in the backyard, you have the ability to be able to do that with a cash out refinance, because you would basically just refinance the house. We'd get an appraisal on the VA loan. You are required to have a new appraisal if you're going to refinance. That's how we determine what the new value of the property is. And nationally across the country, people have a massive amount of equity in their homes right now. So there is the opportunity to pull money from your home and refinance it and take that cash out. You can pay off debt. You can put it into remodeling, a remodel project. Why does remodeling make sense? Because if you are going to put that money back into a kitchen remodel, you're updating a kitchen, you're updating bathrooms, or you're adding square footage to the home, that's going to give you a large jump in appreciation of value. Those are the best returns on investment for remodeling a property, adding square footage, updating kitchens and bathrooms. Now, a shop might be really good for resale value, meaning that when you go to sell the house, somebody's going to look at that shop, and if it's a badass shop and it can park 8 cars, and you've got somebody that, particular buyer that has something they need that space for, they could very well be looking for that particular house and be willing to pay more for that. So obviously a lot of things that people do with a remodel are going to be unique to what their needs are. So cash out refinance, going up to 100% is about an option, but a lot of people would like to keep them under 90% loan to value, and that way you've got some equity still. So if you go to later on sell your house, hopefully values are continuing to appreciate, which they just came out with the Case-Shiller report, and they are showing that year over year, we really haven't lost value in most parts of the country. Now, there are some cities in the country that are different and unique, but if they're looking at like the average in the entire country, they're not necessarily losing value across the country. So interest rates are up, but it does sometimes make sense. We have people that are refinancing that are paying off high interest rate debt. So if you have credit cards, auto loans, RV loans, motorcycle loans, and you're paying a ridiculous amount of money every single month and high interest rates on those debts, you could leverage the real estate equity that you have and pay those debts off. Now, here's the tip on that. If you're going to do that, you're obviously improving your cash flow. The only time it really makes sense to refinance is if you are paying off debt and you're removing a large sum of monthly payments, because your mortgage payment is going to go up. If you're at a 3.5%, and you're refinancing to current market interest rates, your payment's going to go up on that mortgage. But the way that people are still saving money in the long term is if they're paying off debt and they're saving $1,500 a month here with all this consumer debt that's been consolidated into the mortgage, and the mortgage payment goes up $500 a month, then they're taking the $1,000 a month difference and they're applying it to the principal balance of the mortgage versus having this revolving credit card debt, because revolving credit card debt, if you don't pay extra towards those credit card balances, you don't pay that debt off. All you're doing is paying the interest that's being earned every single month. And that's why a lot of people get buried and they get into debt and they can't get out of debt because the revolving debt is hard to pay down. So that's why, doing cash out refinances to pay debt consolidation might make sense. And we're one of those companies, if we run numbers for you and we're like, this does not make sense, we're not going to refinance you just because we can close the loan and make a little money off of you. That's not how we operate. We want to make sure that this is going to be in your best interest. So somebody said take a deep breath. Goddamn. Okay, sorry. I only have an hour, so I'm trying to get through all the information, but I will slow down a little bit. So that is the debt consolidation refinance option. Now, when you're doing a cash out refinance, you do have to credit and income qualify. Typically, the minimum credit score requirement on a VA loan is nothing, right? There is no minimum credit score requirement on VA loans. So if you have credit challenges or you have issues, but you own a home, they're going to look at the most recent 12 months payment history on your debts and primarily the mortgage. They want to make sure that you've been making the mortgage payments on time. So when you're doing a cash out refinance, they're not as flexible as when you're doing an IRL, an interest rate reduction refinance loan. And we're going to talk about that next. So credit qualifying, we will have to have an appraisal. So the cash out refinance is a full refinance. It's going to feel similar to a purchase in as far as like the process goes. You're still going to apply for a loan online, fill out an online loan application. Usually the online loan application takes 10 to 15 minutes. Usually on a cash out refinance, you can structure the loan to where you're not paying closing costs out of your pocket. You're usually structuring the loan to where the closing costs are included in the refinance. And typically you skip 1 to 2 mortgage payments depending on how you want to structure the refinance. So oftentimes you're not paying closing costs out of pocket, you are skipping 1 or 2 mortgage payments, and then hopefully you're either paying off debt, or sometimes people will take a cash out refinance to send a kid to college. And then oftentimes, which what we're seeing a lot right now, is people are pulling cash out to invest into multifamily investment properties, single family investment properties. People are buying land so that they can build down the road if they want to do that. If they're not ready to build right now, but they want to build down the road, they're taking cash out and they're holding or they're paying for a piece of land. So those are some of the options that we've seen. I want to talk about our story, our personal story with buying vacation rentals, because we knew we wanted to buy something, we wanted to invest our money. We didn't really want a long-term rental. It wasn't super sexy to me. I was like, long-term rental, blah, it's boring. Now, I still believe long-term rentals are very good investments, but in the particular space that we were in at this time, we were looking for a vacation home that we could go to as a family. And we thought, okay, if we look for something that is a vacation rental that we could stay in whenever we want to, but we could rent it out and help pay for the mortgage payments, that would be ideal. So we started looking. We were living in Washington State, and we were vacationing in this lakeside town called Chelan. I don't know if anybody knows about Chelan, but Chelan's really well known in Washington, and it's beautiful, it's gorgeous. The water's like, I don't know if it's glacier water, but it's very crystal clear. It looks like the Caribbean for a lake. And it's a really cute little town. It's got, restaurants and boutiques. It's a fun place to go. It's got wineries. So we would go and vacation in Chelan. So we would always stay in rental properties or other people's VRBOs. So we started looking one day, and we found this property. It was a VRB. It was a for sale by owner on Zillow, and it was not currently a VRBO. And it was listed for $350,000. It was like 2,100 square feet. It had a mother-in-law apartment downstairs, which you could not tell from the listing. And it also had 3 bedrooms upstairs, and it had a pool. And it was like 2 blocks from the lake. And you could not tell that it had a pool in the pictures. The photos were god-awful. There was no picture of the pool. There was the pictures of the inside of the house. The lady who owned it, God bless her, was an older lady, and her decor was god-awful. And I would have never seen the photos from that house and been like, I want that one. Thank God my husband dug in deeper, and he did the Google Maps, and he realized there's a pool. It was super close to the lake. So then we started running numbers, and I went on to VRBO, I went on to Airbnb, and I looked to see how much could we rent this property for in the peak season. And I just started looking at other VRBOs, and I started looking at their calendar on their websites to see how much are they booked out. And because we had paid for some VRBOs staying in Chelan, we knew how expensive they were. And we knew that you had to book out, months in advance, because Chelan just gets overloaded during the summertime. Everybody wants to go to Chelan, and there's only so many houses there that are vacation rentals because they do have some restrictions in town. This particular property allowed us to do that. So we ended up negotiating with a seller, writing an offer for $350,000. And when we went to look at the property, we were sight unseen. We sent a real estate agent there to look at the home. We wrote the offer, and then we went to the home and did an inspection of the property. And we realized there was a downstairs mother-in-law apartment. So not only did we have a mother-in-law apartment downstairs, which had its own kitchen, living room, and bedroom. We had the upstairs 3 bedrooms and the kitchen. And then we had this awesome pool outside, and we were 2 blocks from the lake. We literally stole that house. So $350,000. We spent about $5,000 remodeling the inside. And when I say remodeling, I'm talking about we put lipstick on a pig. We painted the walls. We redecorated the house. We made it to be super, I'll share pictures on my Facebook so you guys, or on my TikTok so you guys can see what the inside of the house looked like, but we made it a lake property. You know, I went to TJ Maxx and went to like Home Goods and bought a whole bunch of decor and Target. We put all new bedding on the beds. I did some like chalk paint on the furniture. We kept the old furniture that was in there. Oh, and that's the other thing. We bought it with the furniture. So $350,000 with the furniture, and we decided we were gonna start renting it out ourselves. So the first thing that we did is I signed up for an Airbnb account. I educated myself. We had never owned a vacation rental before. We started an LLC so that we had a business, an LLC, so that we could run our expenses through the business. And then we went and started an Airbnb account, and then I went and found a concierge service that would manage the cleaning and manage any maintenance or any work that needed to be done on the property, because I was 3 hours away. We lived about 3 hours away. So this was our first Airbnb experience. And the cool thing is, this property would rent out solid for 3 months in a row. All of July, all of September, and all of August. Sorry, all of July, August, September. It might rent out for like 1 or 2 weeks in June. And then we did have some rentals during the holiday season, but that's not primarily why people went to Chelan, because there's not like a ski hill nearby. Wenatchee has a ski hill, but Chelan didn't. So most of the people that were coming for the summertime. So they would rent the house out for 3 months solid. Those 3 months of bookings paid for the mortgage for the entire year. So our family, could use the house the rest of the year without having to pay to own that house. So not only did we have that, we also had tax write-offs from owning this VRBO Airbnb. So then we took that house and we rented it out for 3 years, and we turned it into a business, right? Because we had bookings, we had a business. We actually switched from self-managing it with a concierge to having a property management company in town manage the property, which I would highly suggest, because anytime anything needed to be worked on or went wrong, we'd have to run over there, or we'd have to manage the contractors with this concierge service. So I highly recommend, if you're going to VRBO or Airbnb, that you do have a management company, but you have to find the right management company. We used one that's a national management company at first, and I didn't love them, and so we ended up transferring from them to another company. But we had a really good experience. So we decided we were going to move to Florida at a point from Washington State. And we were first going to move by purchasing another second home and turning it into a VRBO. So we started looking, and we wanted to expand to the luxury rental market. So we ended up selling this vacation rental in Chelan, Washington, doing a 1031 exchange. The reason we did a 1031 exchange is to avoid paying capital gains taxes. So anytime you have an investment property and you sell it and you make a profit, you have to pay capital gains. Well, we sold that house for $650,000. Our capital gains would have been $60,000. So we wanted to avoid paying $60,000 in taxes, because I'm sorry, we pay enough taxes already as it is. So we ended up doing a 1031 exchange. We paid $1,000 for the 1031 exchange facilitator. And the rule is you have to identify a property within 90 days of closing on the sale, and then you have to close within 6 months on the new purchase. So you have to close within 6 months. So we found another property that was a vacation rental in Destin, Florida, which we had been doing research on. We also had vacationed in Destin, and it was beautiful, amazing. The beaches, if you haven't been to Destin, it's insane. The beaches are like powdered sugar. It's the Emerald Coast. It's basically the panhandle of Florida in that Northwest Florida region. So we invested. We took the money from the proceeds from the sale. We made an offer on a luxury vacation rental, which was not a vacation rental at the time. It was just an empty vacant house. And we turned that into another business. And that home also cash flows enough with the rentals, and then we just timed it really, really freaking well. So when we were buying in the 30A Destin area, right before COVID, we closed in October of 2019. We could not have timed that any better. So we closed in October 2019. Washington freaking shut down from COVID in February, and we moved into this house for a short period of time just to stay there while we looked for a long-term home. We were staying there for starting in January. So COVID hit in February, and we couldn't stay there anymore, obviously, in Washington, because our businesses were shut down, the kids' schools were shut down. There was no reason to go back to Washington. So we ended up staying in Florida. When we stayed in Florida, we looked for another house because we had to move out of that property into a primary residence, and we ended up buying a primary residence. But this particular house that we have appreciated in value by a stupid freaking insane amount, an amount that we never ever ever would have estimated. And we went for the stars. We went expensive on this next house. We had good income. We had the ability, we had assets built out into some of our other real estate. We had, remodeled those homes ourselves. And here's the thing about us, you guys. I don't care how much money I'm making. I'm going to remodel the house if I can myself. I'm going to decorate the house myself. I'm going to go find the furniture. I'm going to have all the bedding, make sure the bedding is gorgeous. And there's a lot of tips and tricks to make sure that your vacation rental is very successful. And some of those things are making sure that you have really comfortable beds. Try to have king size beds in every room that you can have. Look at the community and see, is this a community that you would want to vacation in? When you're going online and you're researching the other properties that are in the community, how booked out, how far are they booked out? What are the amenities of the home? We ended up having to build a pool with this other home. It was on the water, it's on the bay, so it has deep water moorage for big boats. And in Destin, there's not a lot of boat access where it's deep water moorage. So you have a lot of people that come to Destin to go fishing and they want to bring their big fishing boats. So we've had people that will rent our house out specifically. We've had people rent our house out for 30 days and pay us $30,000 of rental income in 30 days. So I'm talking about a very good investment in the 30A Destin area. And then we ended up buying another vacation rental in Santa Rosa because the market was so good here. For any of you guys that know watercolor in Santa Rosa, I literally rode my bike there one time with my daughter and I was riding around the community and I was like listening to some old, 70s, 80s music, riding my bike, and I was like, I want to live here. This is amazing. The architecture was incredible. There was bike paths all over the community. An awesome community house, like beach house for the entire community. So those are the kinds of things that you want to look for. And obviously everybody has to start out small and you grow and you build into these more expensive houses, but the luxury vacation rental market has been very good. So multifamily is also a really good way to invest your money. The more doors you have, the more units you have, the more rental income you can have. So it really makes sense to look at like cash out refinances if you're going to leverage that money and invest in other real estate. And I'm telling you, real estate is how we have built our wealth. It's not through our regular jobs. It's not through all the work that we do. It's not through building a mortgage company, which we, currently own a mortgage company. None of that has created our wealth. It is real estate that has created our wealth. So I am a true believer and a huge fan of investing in real estate, leveraging your real estate as assets, your equity, to invest in other real estate. I take a lot of heat on here because a lot of people are like, you shouldn't have people maxing out their equity. You shouldn't have people, getting into a bad financial situation. And here's the thing. My intent is never to put someone in a bad financial situation. But the thing about real estate is people have to have a place to live. The cost to build continues to go up. They're not making any more land. And it's a hedge against inflation, which is what we're dealing with now. And real estate continues to appreciate. So I'm a huge proponent of real estate, owning real estate, and investing in real estate in all different facets of real estate, whether it be land that you can develop for long-term building, multifamily units, single family, short-term, long-term, vacation rentals, doing arbitrage, renting to, nurses that are traveling nurses. There's so many options out there, but you need to leverage your opportunities. And the reason why I talk to our military family so much is because you can leverage your VA home loan benefit to invest in all of these things. So taking cash out, investing in purchases of land or homes and properties that can create cash, passive income. The other reason why I like passive income is because you can find a way to generate income without having a high tax requirement, tax implications on that rental income. Because you're going to get huge expense depreciation write-offs. You're going to be able to do depletion, depreciation. You can do cost segregation, which is an incredible way to save money on real estate, is by doing a cost seg. Now, it's an expensive thing to have to pay a CPA to do a cost segregation, but you end up saving way more in taxes than you would to pay for the actual cost segregation. So it makes sense. And we've done that now on, I think, two or three different properties. So I'm a huge fan of real estate. So that's a cash out refinance to use it towards investing in real estate, to use it towards taking a cash out refinance to pay off debt. What else? You could take a cash out refinance to go on an, lifetime vacation, it's like the best vacation of your life. You could take a cash out refinance to send a kid to college. There's a lot of different things that you could do there, but make sure that you're working with a lender that is looking out for your best interest, because not everybody's going to say, hey, I can refinance you right now, but it doesn't make sense to refinance you. Why don't we look at a home equity line of credit? Why don't we look at this other option? And home equity lines of credit are going to be higher interest rates than a mortgage. But if you only need a small amount of money, oftentimes a home equity line of credit ends up being the better option. And we don't really do them because financially it doesn't make sense for us to issue a home equity line of credit for people. Our rates would be higher than you'd be able to get through like a credit union. So we usually turn people back to a credit union to get a home equity line of credit. What is the difference between a home equity line of credit and a second mortgage? So a home equity line of credit is a adjustable rate mortgage, basically, and it's a second mortgage. It's going to be behind your first mortgage. So it takes the second lien position, meaning if you stop making mortgage payments and you went into foreclosure, the bank that's going to foreclose and get the most money is going to be your first mortgage. Then the second mortgage gets paid out if there's money left over after paying the foreclosure fees and everything. So home equity line of credit means that you can, let's say I have $100,000 of equity in my house and I just want to open up a $20,000 home equity line of credit. I could do that and I don't even have to draw against it, meaning I don't have to borrow the $20,000. I can just have it there if I want to invest in real estate. And guys, we're already starting to see commercial loans reset because the Fed funds rate has been increasing. And as the Fed funds rate goes up, banks charge more for commercial loans. It's not as tied to residential loans, the Fed funds increase, but it is tied more to commercial loans. And I can testify to that because I have 3 commercial loans that were refinanced this year with much higher interest rates because the Fed funds increase. So commercial properties, if you've ever wanted to pick up commercial properties, might be a good time to look at that, because down the road in the next 6 months, 12 months, you're probably going to see some properties that are a steal because you have a lot of these resets on commercial loans and interest rates are spiking up on them and people can no longer afford to keep their buildings or their properties, commercial properties. So it's a good time to think about that. But that's the benefit of a home equity line of credit. You can open it. You don't have to draw against it. You can just leave it there available like a credit card, if you will. And as you draw on it, then you're paying the interest-only payments on the amount that you've drawn. And you can also pay it off. So let's say you draw $5,000 because you want to buy crypto, you want to buy XRP, or you want to buy Bitcoin. So you could draw against it, and then let's say you get a bonus, then you can go back and you can pay that amount off and go back to a zero balance. So you're not paying any interest. No interest is accruing on that home equity line of credit. Fixed rate second mortgage is different because it has an even higher interest rate typically than a home equity line of credit, but it's a fixed rate second, meaning it's on a fixed term with fixed monthly payments, principal and interest payments. Home equity line of credit, again, it's interest only. So if you make the minimum monthly payment, you're never going to pay the balance down because it's an interest only payment. You can always pay above and beyond that minimum interest only payment on a home equity line of credit. On a home equity loan, you're going to pay interest and principal. It's going to be on a fixed term, like a 15-year or a 10-year term, and it's going to have a fixed interest rate typically. Okay, there might be some unique programs out there that I don't know about that banks or credit unions are offering, but that's usually the difference between a home equity line of credit and a second mortgage. So, okay, we talked about the cash out quite a bit. Let's go next to the VA interest rate reduction refinance loan. So in 2020 and 2021, those of us that specialize in VA loans call those years Earl-mageddon. And the reason for that is because we did thousands of interest rate reduction refinance loans. And the reason for that is the VA loan is the most badass program, and it allows you to refinance without re-credit qualifying. So let's say you had credit issues. Let's say you had lates in the last 12 months on your credit cards, on your auto loan, even on your mortgage, but you're current. Actually, they'll even refinance you if you're not current on your mortgage, but they don't actually look at your credit history for a VA interest rate reduction refinance loan. They're looking at your payment history on your mortgage, and then they're basically just looking at, are you reducing your payments? So VA has some restrictions and some requirements for a very good reason, because there were a lot of banks and mortgage companies that would literally solicit. Their goal was to refinance every single freaking VA loan in the country. There were call centers that popped up all around the country, And their entire mission was to refinance all the VA loans in the entire country. So they would sit and they would send out mailers to any VA buyers. If you guys own a home and you have a VA loan, you know what I'm talking about. You get mail up the ass. That is just like solicitation invitations. Sometimes they come in like a FedEx folder and it's like an overnight solicitation and they're trying to get you to refinance. That's what they're trying to get you to do, is do VA interest rate reduction loans. VA put out a rule a few years ago that said they don't want mortgage companies churning, because what was happening is mortgage companies would sit around and these call centers, or even not call centers, would refinance VA loans over and over again. So they'd have the same poor borrowers they would refinance over and over because it's hard. They're confusing. They send you paperwork. They send you documentation. They tell you that you're going to save all this money, that your monthly payment's going to go down. And unfortunately, a lot of times there's hidden fees in there that they're not showing you. And then you end up owing more, way more on your mortgage than you thought you were going to with this refinance. And you end up getting screwed over. So we have a lot of borrowers that we have looked at and given second opinions, and we will do that, just so you guys know, anytime you need it. We're not going to charge you for it. We're not going to try and solicit you to use us for financing. If you need us to look at a loan estimate or a closing disclosure or anything that you have documentation-wise when you're going through a loan process, reach out, let us know. We will give you our honest opinion. We'll take a look at it. We'll guide you. We'll give you our honest opinion, because we don't want you guys getting screwed over. But these VA interest rate reduction loans are actually really good and can be really good options for our VA buyers, VA homeowners. So if you have, let's say you have a loan with an interest rate of 6.5%, and let's say the market drops to 4% or 4.5%. And this is what happened during this, Armageddon during 2020, 2021. We had people refinancing multiple times because they went from 6.5% to 4.5%, and they saved 2% in interest rate, which some of these people were saving $600 a month in their mortgage payment. And then another year later, rates dropped to 2.5%. So they refinanced again and save another 2%. So we're not in a position right now where most people are going to be able to do a VA interest rate reduction refinance, but we will be back in that place again, because rates are going to start coming back down, and we have had a lot of buyers that have purchased homes in the last 12 to 24 months that have had higher interest rates. And as rates start coming back down, because inflation is going to settle, rates will come down when inflation comes down. You might even see some quantitative easing again. Obviously, the elections are a big problem right now, or a big deal. There's a lot of things that are holding out for the elections, and we might see some more movement after the election. Between now and then, we're expecting to see rates come down a little bit, but after the election, we're expecting to see rates come down quite a bit. So obviously, it's a crystal ball. We don't know exactly what's going to happen, but it's good for you to know what the VA interest rate reduction refinance loan is for the time when you have the opportunity to take advantage of this. So that VA interest rate reduction refinance loan gives you the ability to go and refinance your higher interest rate to a lower interest rate without credit qualifying, without income qualifying, and that means you don't have to provide us with pay stubs or LES statements or W-2s or tax returns or all the junk that you had to provide when you were buying. We don't have to have an appraisal, so it doesn't matter if your value has gone down below what you owe. And here's the other really great benefit of the VA IRL, the interest rate reduction refinance loan. If your value for some reason goes below, or your value goes below what you owe, then you have the ability still to refinance, and we don't care if you're underwater, if you will. We don't care. And the VA doesn't care. The goal is to give you the opportunity to refinance to a lower interest rate using this VA interest rate reduction refinance loan. Skip 1 to 2 mortgage payments, and you also have the ability to roll your closing costs into that refinance so you don't have to pay anything out of pocket. So most borrowers that we helped in 2020, 2021, 2019, when we're doing all of those IRL refinances, were able to refinance once or multiple times, lower their interest rates, lower their outgoing expenses. Sometimes they shorten their terms from a 30-year to a 25 or a 20-year term to shorten the amount of and lower the amount of interest they're paying over the term of the loan. So the VA interest rate reduction, there's no other loan program that has a refinance that is this easy and this beneficial to the homeowner. So just keep in mind. Now, like I said, you're going to get solicited from every call center, every VA specialty mortgage lender in the country. Just because someone puts a bald eagle on their advertisement or says, they're VA specialists or do VA loans. It doesn't mean that is so. So just beware, be cautious. We see a lot of people get completely screwed over by these other lenders, and we want to make sure that you guys know where you can turn to ask questions and get real information. So obviously we're a mortgage company. That's what we do. We're VA specialists. We are lending all across the country. We're licensed in 33 plus states right now, and we are working on licensing all of the states. We just went independent in January. We just went independent and left this large mortgage company that we were working for the last 6 years. And we started our own mortgage company because we wanted to be able to have control over our interest rates and our pricing and be able to offer more competitive rates. So we are independent. We are running and operating and specializing in VA loans. About 60 to 65% of my staff are prior service or active duty military spouses. And we are all across the country. So let us know if you have questions. We can look at your scenarios. We can help make sure that you guys are getting taken care of and not being taken advantage of. And unfortunately, that does happen. So that's a VA interest rate reduction refinance loan. Now, when you're applying for the loan, the other really cool thing is we don't need a full loan application either. So we actually don't want you to put like your work information and how much you make. And so it's a quicker application process. So if you get to the place where you're seeing interest rates coming down, or if you want us to add you to like a mailer, like an email list that will trigger something and say, hey, rates have come down, it's a good time to start looking at refinancing, you can click on the link in bio or reach out to the team, or you can go to our website at valoanbish.com. If you need a second opinion, go to valoanbish.com, or you can always email us at valoanbish at vlgnow.com. So that's a good place to go to get a hold of us. Or you can put comments here. My team is actually on moderating and answering questions as we speak. No minimum credit score requirement for cash out refinances. No minimum credit score requirement for VA interest reduction refinances. Let's talk about the renovation loan, the VA renovation loan. What is that? So VA does have a program where you can renovate using the home. So you can either use it as a purchase or a refinance. So today we're talking about refinances. So if you have a home that you own and you don't love the kitchen, or you don't love something about the home, you want to remodel the bathroom, you want to update something, you want to add square footage, you want to add a shop, you can look at a VA renovation loan. I have to double check and see if you can add a shop with a VA renovation loan, but anything attached to the house you can do. So what is a VA renovation loan? That's where you may not have the equity right now. So let's say you bought the home last year for $350,000, and maybe you have like $10,000 of equity that you've built up, but you want to take out $50,000 to remodel the kitchen and the bathroom, the master bath. With a VA renovation loan, we get an appraisal and we get bids from contractors. So the first thing we're going to do is get bids from contractors. We're going to look for contractors that are VA approved. Getting VA approved for a contractor is super easy. There's about 5 documents they have to complete. This is the same process to get VA approved as a builder to build a home with the VA one-time close custom construction loan. That's where you buy land and build using your VA loan. Same process for a builder to get approved as a contractor, renovator, builder. It's like 5 documents they have to sign. We can get them the documents, and then we send them to the VA Regional Loan Center, and they get their approval that way. So the VA renovation loan allows you to go off of future appraised value. So if your house is worth, let's say $360,000, you bought it for $350,000 6 months ago, a year ago, and you want to take out $50,000 to remodel the home, you have the ability to be able to do that with the VA renovation loan, as long as your plans, what you expect to do for the remodel, the work that you want to remodel, is going to increase the value by at least that $50,000 that you want to take out. 9 out of 10 times, it does. Every once in a while, we get somebody that wants to spend like a ton of money on countertops or like an exotic wood that doesn't give them the return of value in the equity with the future appraised value. But that is what VA allows you to do. The VA future appraised value is what you use with the VA renovation loan. And the renovation doesn't have to be done until after you close on the refinance. So you don't have to pay cash out of pocket for the remodel and then refinance later on. You actually refinance and then you get the money to remodel the home. You do have to use an approved builder, so you can't do the remodel yourself. That's one thing, unique thing about the VA renovation loan. If you have equity in the property and you want to take out money as a cash out refinance, then you're not required to use a contractor or a general contractor to do remodeling on your house. It's only with a renovation loan that you would be required to use a contractor. So there's obviously a lot of options there, and this gives you the ability to buy something that maybe is a little bit run down and isn't exactly what you want. Maybe even buy something that doesn't qualify for VA financing, but you can buy it with a VA renovation loan, which means you can close on it with a VA loan 0 down before the work is actually done. So that is a great option, VA renovation loan. It allows you to buy something and renovate it, or refinance something that you already own and renovate it. And yes, you have to own or occupy any one of these VA loans that we're talking about, except for the IRRRL, which I didn't go into that. So an IRRRL refinance allows you to refinance a property that you previously occupied as your primary residence, but no longer occupy as your primary residence. So you can do an interest rate reduction refinance loan on a investment property that you no longer live in, okay? That is an option for you. But the cash out refinance, the VA renovation loan, you have to live in it, you have to occupy it as your primary residence. So the rule with VA is you have to intend to occupy it as your primary residence, and you have to move in within 60 days of closing. So, and then with a refi, you have to be living in it at the time that you refinance it, okay? So those are the requirements with the cash out refinance or the VA renovation loan. We absolutely do jumbo loans all across the country. We've done, our highest, I think, is $3.5 million for a VA loan, 0 down. The interest rates at the time were 2.25%, and you can't steal money for cheaper than that. I mean, borrowing at 2.25% and having a mortgage, 100% financing on a $3.5 million house, and that dude's house 2 years later is worth $6.5 million, because that is the kind of appreciation and value we see on 30A in the Santa Rosa area of Florida. And that is why investing in real estate can make very good sense, even if your mortgage payment, which I hear this a lot, anytime I talk about jumbo VA loans, people are like, yeah, who's freaking affording an $8,500 mortgage? You guys, we have a lot of VA buyers that are affording an $8,500 a month mortgage payment and still have tons of money left over. They have careers, they have businesses they've started, they are, entrepreneurs, they are drivers, they're achievers, they've been lucky, I don't know, they've had parents that have businesses that have brought them into it. I mean, it's all of the above, all of those options. But we do have a lot of buyers that are buying $1.5 million plus. And yes, we are lending in 33 plus states. California is one that we should have any day now. California, we've been waiting for. They have our entire package. We've gotten first approval. We're just waiting for our final approval. So we should have our California license hopefully within the next week or so. But if you need something immediately, we can refer you to someone who has a California license, but we are very close. Minnesota, yes, we are licensed in Minnesota. And I'll have my team go ahead and put up on this chat what states that we are licensed in so that you guys know. But yeah, so VA renovation, the VA interest rate reduction refinance loan, the VA cash out to buy investment property. We talked about some ideas for vacation rentals or short-term, long-term. We do offer education on the VA one-time close, buy land and build, because we do have a 0 down program that will help you finance land and building together in one loan. It's 0 down up to $4 million, and you only have to have a 620 credit score. You're not going to be able to find anybody else that has a program that's more aggressive than that for a VA custom construction loan. And you can build a freaking multifamily up to $4 million. So what market would you do that in? California, Florida, potentially, and parts of Florida. And the states that we're seeing the most VA loans closing in, Texas, Florida, more than California, way more. And it's probably because of affordability, right? California has some areas that you can't find a house in an affordable price range. So we're seeing a lot of growth and migration happening. A lot of people are moving out of California. They're moving into Boise, Idaho. They're moving into Kansas and Colorado and Alabama, Arkansas. We're seeing a lot of migration to the south. Texas, of course, you could build in Texas for the next, I don't know how many years and still not have all of Texas built. I've driven through Texas. Takes I don't know. I don't like to drive through Texas because it feels like it takes fucking 4 days to get through Texas. And parts of Texas are not pretty. There's a lot of Texas I absolutely love. And, we've been able to spend a lot of time in the San Antonio area. Actually, next week, we're going to go live with one of our builders in San Antonio. We're going to talk about the VA one-time close, custom construction loan, buying land and building. It'll be amazing. So the cool thing about the VA custom construction loan too is that when you're building the house, you do not have mortgage payments. You're not allowed to make mortgage payments when you're building that house. So you have the ability to build a home, a second home, which obviously it will become your first home because you have to move in as your primary residence, but you have to live somewhere else while you're building, and you're not making mortgage payments while you're building this house. So a lot of people are looking into this buy land and build option that we have. With that being said, I'm going to segue into releasing your VA entitlement by refinancing from a VA loan to a conventional loan. So let's talk about what that means. You have the ability to buy multiple homes using your VA loan, right? But the only time you don't have a county cap is if you don't have a VA loan outstanding. So for those of you that are tuning into this, it's a refinance video, you probably have a VA loan right now. But if you want to buy something else and you want to keep your house and you don't want to sell it because it's going to be a good investment long term, you want to hold on to it, you do have the ability to do a one-time restoration, which is where you refinance your VA loan into a conventional loan and you release your VA loan entitlement. One time in the history of using your VA loan. So you got to make sure it's the right time that you're using this. But this is how you can have a $450,000 house that you used the VA loan on and do a refinance from VA to a conventional loan, do a one-time restoration, turn that house into a rental property, and go buy $1.5 million property or an $800,000 property, regardless of what the county caps are. Okay, so that is why you would refinance from a VA to a conventional loan. Again, you can only do it one time in the history of using the VA loan, so it wouldn't make sense to try and do this over and over again. You really want to figure out and kind of, have some strategy behind when you do this. But it is an amazing option for someone who bought a house that they love. They know it's going to be a good investment property. They want to hold on to it, but they want to build or they want to buy something else that's over the cap of what's available to them. So they decide to go and do the one-time restoration, release their VA loan entitlement, and reuse their VA loan with no county cap and no down payment. So that is absolutely an option, and we would refinance from a VA to a conventional loan. So if I do the VA one-time close loan and refinance into a conventional, I can reuse the construction loan. You could, absolutely, yes. So you could use in theory, you could use the construction loan multiple times. And here's some different scenarios for you. So I use the construction loan to buy land and build. I start in an affordable market like Georgia or Arkansas or Alabama, where I can get a lot more, South Carolina, North Carolina, some parts of Idaho, not Boise, Idaho. Boise, Idaho is insane now, but like other parts of Idaho, more rural. A lot of rural areas in the country are going to be less expensive. So you could buy land and build, and let's say you build out and it costs you $350,000. Well, the county cap right now for the VA loan in most counties across the country is like $726,200. So if you spend I'm going to say $300,000 because I don't have a calculator in front of me and I'm not that good at math without a calculator. I have become super reliant on a calculator. So let's say you build out at $300,000. That's your total cost to build. And you live in that house because VA requires that you occupy the home within 60 days of closing as your primary residence. You live in that house. Let's say 12 months later, you want to build another house. You have a $300,000 loan outstanding here. So now you qualify for, based off of current county cap, for the regular VA loan limit. If you're not going to a high cost area, you would still have $426,200 left, zero down. Now, it doesn't mean you can't go over that zero down amount. You have $426,200. You could go to $500,000. But if you go to $500,000, your requirement is that you have to pay 25% of the difference between $500,000 and $426,200. And so 25% of the difference, I'm just going to calculate it real quickly because I've got my calculator right here, $426,200. So that's $73,800 is the difference. I have had banks and mortgage companies, and some of the VA specialty banks and mortgage companies, the big insurance company and the big credit union who I bank with, tell people you have to bring in that amount, $73,800, to the closing table. I had a dude liquidate his entire TSP one time because he was told he needed to bring in that amount to the closing table when he went over his VA loan limit. You do not need to bring in the entire difference. You only need to bring in 25% of the difference. So 25% of that would be $18,450. So you can imagine he would have been much happier to take out $18,000 from his TSP versus the 60-something thousand they took out. So that does suck. But yes, you have the ability to buy land and build. And then if you wanted to and you have enough entitlement left, you could buy land and build again down the road. And then if you reach that point where you've bought land and built twice, you maxed out your VA entitlement, now you need to refinance one of those homes. You cannot refinance both and release them both to conventional loans and restore your entire entitlement. You can only release one of them and do it one time. So either way, you still have entitlement outstanding unless you sell that house, okay? So that is an option for you. You can absolutely do that. You can reuse the VA loan multiple times over and over again. And if you're gonna look at the buy and build option and you're interested in creating a portfolio of rental properties and investment real estate properties, look at the multifamily VA buy land and build option. You can also do barn dominiums. Those are an option. You can do modular homes. You can do manufactured homes. You can do stick-built houses. There's a lot of options on that VA one-time close custom construction loan. That happens to be where we get most of our questions, and most people are interested in our videos and information because of that buy land and build using the VA loan program. But we just wanted to do this refinance video so that you could see a little bit more about what does it look like to refinance using your VA loan. And we are going to see more people refinance, continuing to look into refinancing as rates continue to come back down. Let's see here. What other questions? I heard it's hard to do this when you're about to retire from service. This is a really good question. So there is a timing strategy that you need to have if you're planning on getting out, EOSing, ETSing, retiring from the military. There needs to be some strategy behind your timing, because if you're ETSing within 12 months, then we are required by the VA to, if we're going to use that income, your active duty income, we're required to get a letter from your CO saying that you qualify to reenlist and a letter from you stating that you plan on reenlisting. If you truly are not planning on reenlisting, you don't want to go down this road. But you would have other options of looking at your long-term pay. Like, for instance, we have a guy that just talked to yesterday, and he's wanting to buy land and build in Arkansas. He's an E9, he's getting out of the Army, he has been in for 30-something years, he has retirement, he's going to retire, he's gonna go on terminal leave, and then retire out. We can use future retirement pay. We can document how much retirement pay he's going to be receiving based on how many years of service how many years he was in service, and based on how long and what his rank was, that will show us what his retirement pay is. Now, he doesn't have his disability rating yet. He will have that hopefully closer to the end of his service, maybe right after he gets out, maybe before. I don't know if he's med boarding or not. Sounds like he's retiring out, so I don't know that that's part of the process, but there is the option to use VA disability income as well if we have an awards letter. So that is future pay. Now, if you're ETSing within 12 months, that's the situation. If we hurry up and close you before you're within the 12 months, then we can use your active duty pay. So it's when you get within that window from 12 months to closing, so a closing date, and your ETS date within 12 months, that's when it becomes a problem. That's when we have to have the letter from the CO stating that you qualify to reenlist, the letter from you stating you plan on reenlisting, and everything has to make sense. The other option is you can have your spouse occupy the home. So if you're in your final duty station, and let's say you're stationed at Fort Bragg, but that's not where you want to end up. You want to build in Georgia, or you want to buy a home in Georgia, and that's where you want to end up after you retire. Then you can send your wife ahead of you, or her husband, or spouse, whatever it is. They have to be legal spouse. You can send them ahead of you and have them occupy the home, the VA loan, and the property that you finance with the VA loan. You can have them occupy ahead of time before you get out, so that you can still use your active duty pay. We might have to look at where are you staying when you're stationed at Fort Bragg? Are you staying in the barracks? Are you renting a house from a friend? You don't want to be in a lease agreement. You want to be staying with a friend so that we can just hit you with a couple $100s a month that you're paying your friend. But that's a really good option for you to be able to buy ahead of PCSing or ETSing out of the military so that you don't have to deal with income qualifying issues. If you get within that 12 months and it's too late, then we can use an offer letter from a permanent job after you get out, but there's a window of time, and usually it's 60 days, something like that. It's going to be an investor overlay. VA doesn't require a specific amount of time. They just say it has to be a reasonable amount of time, but a lot of investors will overlay that and need you to be starting your job or have your first paycheck before your first payment is due. A lot of lenders will tell you you have to be starting your new job before you can actually close on anything and before you can use that income to qualify. That is not our stance. We are allowing people to close just off of an offer letter before they've actually started the job, but we have to look at the timeline because usually it's, within 60 days you have to start the job post-closing. But there are some options there. Can you buy a vacation home with a second VA loan? So VA's requirement is that you're living in the home over 6 months out of the year, and that it makes sense that is your primary residence. So you can't have your main job be in Pennsylvania and then buy a home in Florida using your VA loan and call it a second home. But I did have a family that was moving from New York, starting a new chapter branch of their tree business. They had a tree business. They were self-employed. They were going to continue to run the business in New York. They were the CEO of the company. They had project managers that were running the New York division, and they wanted to buy using their VA loan down in Florida because they were going to live in the property in Florida more than they were going to live in their property in New York, and they were going to continue to maintain the business in both locations. So he also had VA disability pay. So we did allow, and the underwriters did allow him to occupy as his primary residence using his VA loan. But if your job's in Pennsylvania or in another state and you're trying to purchase in another area and say that you can, work from there, unless you have a telecommuting job where you can actually work from anywhere and your employer will verify that, then you can treat it as a primary residence because your goal and your intent is to live there more than 6 months out of the year. So you have to do that. Let's see. Will this be posted? Yeah, we are going to post this on YouTube. So just give us a couple days. I don't know if we're recording this one, but if we don't, we'll redo it so that we can have it posted on YouTube. It's a bummer that these VA TikTok lives or these TikTok lives aren't recordable, and so you can't keep it on TikTok. I don't know why they're doing it that way, but VA will approve DTI to about 58%. Depends on your lender. I like comments like this because I'm always curious, where did you get that information? Because we have gone way higher than 58%. VA's rule actually goes off of automated loan approval. So we've had automated loan approval for borrowers that are 72, 74%. Now, I don't want that to sound irresponsible. We're not trying to push people into houses that are too expensive for them. 72%, because VA does this calculation called residual income calculation, and the residual income calculation shows how much money you have left over after buying groceries, paying for your utilities, paying for car insurance and other kinds of expenses like that. The VA residual income calculation is supposed to calculate what the cost for a family size of 5 in the Southwest is, and then you're required to have 120% of that if you're going over a 41% debt to income ratio. I know there's a lot of numbers I'm throwing out there, but basically what it means is a lender's not being irresponsible if they are allowing a veteran to buy with a higher debt to income ratio like a 73%. It's because they have really good residual income left over. And it's kind of like AI. The automated underwriting system is saying, yes, I like the risk on the loan. They're reviewing and underwriting the credit report and looking at all your credit history. They're looking at your job history. They're looking at your assets, money in the bank. They're looking at your debt to income ratios. They're looking at your residual income. All of those things factor in to the yes or no that you get from the automated underwriting system. If you get a yes or no, if you get a yes from the automated underwriting system, then you can go well above the 58% DTI that Curza posted. And it will depend on lenders. I agree with that. Lenders do overlay this particular requirement. So when it comes to debt to income ratios, we, Veterans Lending Group, VLG, we will not overlay the VA. We don't restrict your benefit. The way the VA wrote the benefit is that there is no number requirement. It's how, what debt to income ratio do you get automated loan approval up to? So it's all based on automated loan approval. So that's that answer. I want it for investment property. Wife won't sell, move. Oh, that's a tough one. Big slick. So where are you guys living now is my question. And why does your wife not want to sell or move? So we're seeing a lot of that. Obviously, you get into domestic sometimes when you're looking at one party wants to move to another part of the country. We're seeing a lot of migration happen. And we left Washington State. Washington State's beautiful, but they have a lot of issues right now. The drug use and the state funding and the politics there, it's insane, and it's a big problem, and it continues to go downhill. And you guys, I'm sure you've heard of Seattle. We were in Detroit last month, and our friends in Detroit were like, we won't go to Seattle. It's fucking crazy there. It's dangerous. And we're like, okay, you're in Detroit saying you won't go to Seattle? That's like, that's a sign. So yeah, congratulations, Seattle. You're now like one of the most dreaded places that people want to visit. And it's really sad because you were really gorgeous and beautiful at one point. Okay, so what other questions? In California, what do we need? We both have good credit scores, wondering about salary requirements. So this is kind of what we were just talking about, debt to income ratios. And here's the other thing, like there's so many, I could go on for hours and hours about VA income calculations. And if you haven't been in that same field for a 2-year period of time, get a second opinion if a lender is telling you you have to be in that field for 2 years, because we hear that all the time and it's wrong. A lot of overlays, well, I guess I shouldn't say it's wrong. It's very specific to your transaction. And most of the time, the other lenders are wrong. Most lenders do about 10 to 15% VA loans. The rest of all the loans that they close are conventional loans, which just so you know, conventional loans are very black and white. You either qualify or you don't. You have to have a debt to income ratio of this or not. You don't qualify. It's so black and white. VA guidelines allow you to really dig in and understand the story and figure out why these borrowers maybe had late payments, why there were credit challenges, what happened in the divorce, what happened in the deployment. Did you deal with an injury when you were deployed, or emotional stuff when you got back, transitioning out of the military? Like VA is written as a benefit to our service members. Conventional loans were written as a loan program and guidelines. So it's a completely different situation. So get a second opinion in any case, any situation. If you're being told that you don't qualify or you can't qualify for what you want to qualify for, just get a second opinion by a VA specialist. Because like I said, most of these mortgage companies, less than 10% of the loans that they're closing are VA loans. They don't know what they're talking about. They just don't have the experience. It's like, it's like a surgeon trying to fly a helicopter when he has zero helicopter experience, or maybe has like sat in the cockpit of a helicopter but hasn't actually taken control of a helicopter. Like, you don't want that happening, and that's what the difference between a VA specialist and just a regular lender are. So regular lenders will likely give you not great answers. Salary requirements, that's kind of a broad question, so we'd have to get a little bit more specific. And obviously our team, the comment above wants to understand what it would take to purchase a $1.5 to $2.5 million property. So a lot of that's going to depend on what are the taxes and insurance on the property. I know California is working to create some tax exemptions for disabled veterans, and hopefully that passes in the state of California, because we do have a lot of veterans living in California and a lot of disabled veterans. That's why people move to Texas and Tennessee and Florida, because you get tax exemptions on property taxes if you're a disabled veteran. So hopefully California will pass that. That would be super awesome. But you have to look at the total mortgage payment, right? PITI, principal, interest, taxes, and insurance. And when you look at that, you also have to look at other debts. So what other debts do you have? Do you have car loans? Do you have student loans? Do you have credit card debt? All those things have to be factored into your total debt to income ratio. So it's, I'd have to post some numbers and like do a quick calculation. And I'm going to say, here, let's just see. I'm going to try and do this for you real quickly and whip this out. Basically, if you stay under that 60% of your gross income, so gross income meaning before your taxes and insurance, or before taxes are taken out. If you have VA disability income, or you have Social Security income, or you have other non-taxable wages, then we actually get to gross up those non-taxable wages. So if you receive $1,000 a month in VA disability income, we actually get to qualify you with $1,250 a month because we gross it up by 125% we can use. And the reason for that is because when you're looking at salary from a job, we're looking at your gross income before taxes are taken out. So when it's non-taxable pay, they let you gross it up. So we look at, take all of your pay, that's qualifying pay, and then we look at your minimum monthly requirements for any of your debts, car loans, student loans, credit cards, any of that stuff. And the reason why it's so important that you talk to a VA specialty lender is because you might have student loans. Let's say you have $100,000 in student loans, or your spouse does, and they're deferred right now. So you're not making payments on student loans. Well, VA allows you to eliminate those payments if they're deferred, as long as we can verify that they're deferred for 12 months post-closing. If they won't be deferred for 12 months post-closing, then you can't eliminate those payments from your debt-to-income ratio. There's a lot of things that can be navigated and structured in such a way to benefit you for qualifying purposes. But unless we get a chance to talk to you before you are jumping into going under contract on a house, we can't necessarily help you navigate those things ahead of time. Also, self-employed borrowers, oftentimes your taxes are drawn in such a way where your CPA is trying to save you money, but what they're doing is kind of screwing you over for qualifying for a mortgage. So there are some tax write-offs that we can give you that will help you from a credit qualifying perspective and income qualifying perspective to purchase a home, but they don't hinder you from a tax requirement perspective. So they keep your taxes lower, your taxable wages lower, but you can add certain things back in for mortgage credit or mortgage income qualifying when it comes to self-employment. So if you're self-employed and you're considering buying a home, reach out to our team and we're happy to look at your tax returns and kind of guide you through. We're even happy to talk to your CPA and say, hey, we need you, this is what you should do. These are the write-offs that you should use, because you can change the way you file your taxes. You don't have to take all those tax deductions. There are certain tax deductions that are better for you because we can add them back in as qualifying income when it comes to tax income calculations for mortgages. So there is some navigation that happens with that. So back to the dude's question, Rio's question on having good credit, wanting to buy $1.5 to $2.5 million property. Rio, are you buying this property as an investment? Is it going to be multifamily? Are you going to rent any portion of the house out? Or is this just your primary residence? If you're looking at a $2.5 million property, and you're looking at probably a 30-year term, I would imagine, based on current interest rates, that $2.5 million is probably going to be somewhere around $15,802 a month, principal and interest. And then you have your taxes and insurance on top of that. That's an interest rate of 6.5 with an APR of 6.87. So we'd have to obviously dig in a little bit deeper. $1.5 million, just to kind of give you the difference between the two, $1.5 million is $9,481 a month plus taxes and insurance. And again, that's a 6.5% interest rate with an APR of 6.82. So we can go into detail further on that. That's what with current interest rates, we are expecting to see interest rates continue to come down. You also can have the seller pay to buy down your interest rate, which is a really incredible thing to do. And with VA loans, you can go zero down. So I would keep your money. In this particular scenario, we had a VA buyer in California that was buying a $1.5 million house. He was going to put $60,000 down just because he wanted to have some skin in the game. And we ran numbers for him. His payment would have been $8,500 a month with principal, interest, taxes, and insurance, I believe. $8,500 a month if he put the $60,000 down as a down payment, or we took $30,000 of that $60,000, used that to buy down his interest rate, and he ended up saving $1,000 a month by using $30,000 of the $60,000, and then he got to save the other $30,000. So there's a lot of things that you can still do to lower your interest rates, lower your overall interest. When you make one extra payment towards the principal balance every year, you reduce your mortgage term from a 30-year to a 26-year term, and you knock 4 years off the interest term, 4 years off the term of the loan, 4 years of interest off the loan. So there's a lot of stuff you can do being creative, and the current interest rates that we have right now are more historically typical for interest rates in the US. We just happened to see some really incredibly low interest rates for a while, which was very sweet, and we got used to that. So there's a lot of different options. Hopefully we got most of your questions answered. Can I sell both VA properties same time and get all entitlements back? Yes. So when you sell your property, that releases your VA entitlement. The transfer of sale releases your VA entitlement. So if you wanted to sell all of your VA properties, you could absolutely do that. And I would look into a 1031 exchange if you're planning on doing that, because you will pay capital gains taxes unless you lived in the home. And I'm not a tax advisor, just full disclosure. My personal experience is you will pay tax. I've paid taxes on a home if I didn't live in it for 2 of the last 5 years as my primary residence, or there is a veteran exemption on that if you were deployed, I believe, or had to PCS due to orders. But otherwise, you could do a 1031 exchange to avoid capital gains taxes, which means that you basically roll the profit that you made on the home into another like-kind exchange, so another similar property that you're investing that money into. So there's a lot of options there. Reach out if you guys have questions. We're licensed in 33 plus states across the country, but we can always give you just some general advice on estimates if you guys need a second opinion. Thank you for tuning in. We are going to try and get this up on YouTube, and if for some reason it didn't get recorded because I don't have my full marketing team today, if it didn't get recorded, we'll re-record one again and put more tips and tricks up. Follow our page. We're always bringing more information. Our goal here is just to educate our military community about your VA home loan benefit. And then if you guys want to work with us, we'd be happy to assist because, we love working with our military family. So thank you so much. Happy Wednesday night, happy hump day, and enjoy the rest of your week.